Hi, everyone. Welcome to YXI Insights. Today is May 23rd, and we are in the New York morning time. So today we're going to go through some of the late macro analysis, the FOMC path, and then quickly get into the chart analysis for SPY, QQQ, TLT, USO, Bitcoin, Max 7 stocks, gold, and SOXX. All right, let's begin. So this is my daily dashboard for today. So I want to just go through a few items at the front. Fed liquidity on a 1 month basis is pretty much unchanged. So we had a benign environment where Fed liquidity helped supporting high bond prices and lower yields at the beginning of the year, but now that's been flatlining. And of course, on the margin, it doesn't really help bond prices as much as earlier in the year. So we're seeing yields rising on the concerns of budget deficit, but with the backdrop of not really a helpful macro environment either. And looking at the G5 M2 levels, that has been expanding. It has been expanding nearly throughout the first half of this year. And that has essentially helped Bitcoin recover faster than stocks and move into the all-time high this week. So that wasn't really a coincidental occurrence where Bitcoin follows a 3-month lag in the same direction as the global M2 levels, and that global M2 levels have been rising. And at the same time, the dollar has been weakening. This is primarily due to investors fleeing the US capital markets from the bond markets and back in April from equities. And what I've observed, interestingly, is that while the US equity markets have been recovering very strongly, there has been consistent outflows in SPY and QQQ, at least in the first half of the rally. So I think investors only really getting less skeptical now towards the health of the market. And then looking at the treasury yields, the 2-year yields and the 10-year yields haven't really, the curve hasn't really changed its shape in the past 4 weeks. But on an absolute level, the 2-year yield and the 10-year yields have both risen by more than 20 basis points. The changes overnight from yesterday, we saw very little moves actually across bonds, gold, or risk assets. Bitcoin made a new all-time high, breaking above 110K, which is great. SPY, QQQ, IWM basically closed the day on flat. It was good that we didn't see a continuation of the pullback from the day before, but the market has been pretty muted going into a long weekend. And now looking at the FOMC dates, and what we see is that the market really sees 3 to 4 cuts in the next 12 months. So why is it not 3, not 4, but 3 to 4 cuts? It's to do with the pricing, the way the Fed Fund futures are priced. So if you look at those for each meeting, how much cuts the market prices in individually for those meetings and tally them together, we see about 85 basis points for the next 12 months being priced in. And that is in between the 3 and 4 cuts from today's level. So overall, still definitely not a recessionary pricing, and on the margin actually it's probably more hawkish because the Fed already signaled 2 cuts for this year and then 2 more next year anyway. And the market is probably just really following that script for now. So no recession is being priced in. So depending how you see the economy evolve, being long, I understand people who are trying to be long in the front end and picking up those locking in, for example, the 2-year yields, given the current level pricing. The Fed is very unlikely to hike anyway. So really the cost of holding 2 years is carry. What it means is if Fed does nothing, the yield curve will move higher, so the 2-year will drop if the Fed does absolutely nothing. But at the same time, you're picking up good risk reward for in case there is a recession, and then we are probably pricing in 5 or 6 cuts, or 6 or 7 cuts in the next 12 months, if that does happen. So that's what you got to weigh against in holding the front end bonds. Looking at our YXI Signals daily, we've developed a full suite now across SPY, QQQ, Bitcoin, TLT, and all of the Max 7s, and we even have a PLTR in the mix. I think the final one I'm going to develop for this service is gold, and we are just going to stop there and just keep monitoring how the models perform over time. Pretty much risk on still today. All of the risk assets are showing ones, and TLT is showing 0. Unfortunately, we tried to get more bullish on TLT early in the week, got wrong-footed by the bond auction, and now it's back to 0. So on the margin, the model still thinks that yields could be moving higher from here. All right, so let's look at SPY here. The market just opened and is down roughly 1% at the open. So what's going on here? SPY is at a dangerous crossroad. And what do I mean by that? If we look at this first rally, after Trump has given pauses on the tariffs for every country except for China on April 7th, which reversed some of the losses into April 9th, and then the pullback into April 21st, and then the second rally from the 21st to this Monday. If we look at the size of 2 rallies, the second rally has stopped at the 1.236 extension of this first wave, right? So the 2 possibilities are, first, it could be a 1-2 wave 3 that is incomplete so far. So I deem wave 3 to be at least reaching the 1.382 extension, which actually is where this resistance line, the trend line, is that used to be the support. So there is a lot of confluence here in terms of technical levels. But if the price action cannot get past the 597 level, which is what we topped on Monday, then there's a very good chance that this is only an ABC correction. And what that means is this is still potentially a wave B corrective move of the April 7th high. So unless we exceed 608 or 609, we are not in the clear for the bullish move. And of course, if we get to this level, then we are making a new all-time high. And I understand people really don't like buying out new highs, but making a new all-time high is a very bullish signal for the health of the market. So right now, my primary expectation is still we're going to reach this wave 3. And currently, we're just doing this retest of the 200 EMA and the gap fill. But if we turn down here sustainably and pass those candles here, past this volume profile here, then there's a real danger that we're looking at this being a B wave and a larger degree C wave making a new low. So we're not quite there yet, but we have to prepare for these alternatives. The QQQ price action has been more bullish. In terms of this second rally, the waves have exceeded 1.236 extension of wave 1. And that puts us slightly shy of the 1.38 extension, but there's a high likelihood that this is a wave 3. And given that SPY and QQQ are highly correlated, if QQQ is in an impulsive 5-way move up, then of course SPY is likely to make a new high as well. So here the QQQ is giving us a little bit more clue as to the bullish trend. But unless we really clear this 527 level, we cannot rule out this being a corrective B wave with the ABC subwaves here. Right now, we could just be filling out this gap and retesting 200 EMA before we head up for this probable wave 3 that could be 527 to 546. But we have to be cautious of the bearish alternative as well. And again, this trend line here that used to be the support of QQQ between October and actually into January, that was broken in February, and now we're meeting that zone again. And I would just look at the chart holistically. It does very much look like a mirror image to each other. We had steep drawdown followed by a very quick recovery. It does look more like a V-shaped recovery for now, and of course, we really need to get above the 527 to confirm this. So now look at the 30-year yield. We had a pretty terrible 20-year US Treasury bond auction earlier in the week, which resulted in the yield spiking by 10 basis points on Wednesday. And I think the 20-year auction landed at 5.1%. And we're more focused on the 30-year bond. We are looking at decisively yields moving past 5% mark. I think the path of least resistance is for yields to travel higher, especially now the tax bill is looking to get passed in both houses. We have been pretty bearish on bonds, which means we expect yields to go higher from essentially early May. And we've been staying on the sidelines for TLT for a while. I think the best case scenario is that we have an ABC correction, which this C lands in between the 100% to 123% extension of this wave A. But there's a very high likelihood that we're actually in an impulsive 5 wave here, and we could see yields getting as far as almost 6% due to the investor worries of fiscal deficit. And it's not really because, so first, the Fed doesn't really want to cut in the current economy with the strong labor market. And secondly, investors are demanding higher term premium for longer duration bonds. What that means is investors are looking for higher yields to compensate holding bonds for 10, 20, 30 years, as they're worried that the government will flood the bond market with higher supply with bill issuances if they cannot control the fiscal deficit. So correspondingly, we are not bullish on TLT here. TLT made a new low this week, getting past the April and the January lows, and actually also breaking below the April 2024 low. So this is not good news for bondholders, and I can see the best case scenario for it ending just about around the 80 mark, but actually there's a very good chance that it will dip below 80 and get into the mid 70s for TLT. Looking at gold here, I think we did bottom in this wave C here. So this wave C is roughly equal distance between the 100 and 123% extension of this wave A. That has marked complete. We didn't get a further drawdown for impulsive 5 waves down, which is good. But right now, we are still not in the clear for the bullish legs yet. This very well be a corrective 3 wave up in wave B, followed by a wave C down. So it's quite early to say whether this is going to be a B or actually we're going to get the full 5 waves up. The only tell is if we can get a wave, the third wave being substantially longer in length than wave A. So we haven't even got the pullback yet, so it's quite early to tell. But I think given the blow off top we've seen at the beginning of the year, I do expect a much larger pullback than the one we've had so far. In terms of fund flows, I have seen that GLD essentially has seen consistent outflows every single day since this April 22nd top. So the institutional investors now are stepping back from chasing the gold prices here. Now looking at gold's younger digital sibling, Bitcoin, it made a new high this week, and it went as far as 111,000. That is higher than the previous highs in both January and December. And that essentially has been a textbook play following the global liquidity. So if we just look at the global liquidity chart for the second, the G5 M2 money supply, G5 being US, UK, China, Eurozone, and Japan, topped at the end of September. We had a corresponding top in Bitcoin in December, so roughly 11 weeks lag. And then we had the M2 money supply bottoming around second week of January. And then we have Bitcoin bottoming almost exactly 3 months later. And now we are moving past a new high. And this is really following the script of Bitcoin following the global liquidity pool or the expansion of fiat money. So there has been questions about, okay, this supply, money supply data is released by central banks on a monthly basis. So all these fluctuations that you see daily is really the dollar being stronger in this period and weaker since January. But that is kind of precisely the point. First of all, the M2 money supply from China or UK or Japan only really matter to us in dollar terms, as Bitcoin is quoted against the dollar. So if dollars are stronger, by default, the asset you're purchasing with is weaker relatively, right? So this absolute strength of the dollar has a direct impact on the asset level. Then secondly, dollars do matter because the things that you use in the global shadow banking system, like US treasuries, European government bonds, high grade credit, FX swaps, all of these things are quoted or traded in dollar terms, right? So they're thought of in dollar terms. If dollar is stronger, then the collateral value is smaller, and therefore there is less liquidity in the system. Less liquidity, there's less money moving into risk assets like Bitcoin, right? So the fact that the data is a monthly data that moves with global exchange rates on a daily level is actually absolutely relevant and does have high explanatory power for why Bitcoin is moving in sync. But actually, if you abstract this away and you say, okay, money supply is expanding anyway, and why don't we just follow the dollar? That is actually also the right way to look at it. So let's just move back to the Bitcoin technical analysis here. So I did think, originally I was expecting this being wave 1, wave 2, and maybe there's a wave 3 and wave 4 here. But actually just looking at the chart holistically, I actually do think we are in an extended wave 3 move. So first of all, if you look at the grand scheme of things, the wave 5 typically is at the 138 to 176 inverse extension of this wave 4. So the drawdown of this wave 4 inverted is how we get to the wave 5 target. So that puts us in the ultimate termination range of 126K to 146K range for the cycle top. That's our baseline expectation. And then secondly, this could not really be a wave 4, even though in terms of fib levels, this does kind of fall in line with the textbook. So we have one and a very shallow wave 2. If this was a wave 4 in the alternating principle, if wave 2 is shallow, wave 4 tends to be steep. And that makes sense because the investors got very excited very quickly with very little pullback initially. And when it hits a certain level in wave 3, they're looking at, oh, have we topped? Is there some risk we haven't been aware of? Has the rally gone too far? And then the wave 4 feels like people cashing out. It does feel like possibly a cycle top already, and before ultimately the bulls who bought the dip win the day and carry out the final wave 5. So, and vice versa, if the wave 2 has been very steep, we had a very skeptical beginning to this rally, and then we are entering euphoria era in wave 4, with a very shallow pullback in wave 4 to carry out wave 5. So there is a alternating principle in Elliott wave theory, and we haven't really seen that yet. We've seen shallow pullback, shallow pullback, shallow pullback. All of this suggests to me is that we are at the beginning stages of a extended rally here. And we possibly could have had 1-2, 1-2 setup, both very shallow 1-2s, and followed by possibly more volatile and bigger drawdowns in wave 4s. So this is my current hypothesis at the moment. Of course, it could get invalidated if we decisively get back down into this 200 EMA level and then not looking back at all. But this is kind of my expectation right now. And currently, I do see the next resistance being the 138 extension of this wave 1 of the large degree wave 3 that puts us in the 115K plus range. And so I do think from here onwards, it's quite normal to see volatile sideways actions a bit more as people debate whether they should chase this rally at the all-time high, etc. And people don't like buying at all-time highs, but I do think we haven't topped yet. Looking at oil, so for oil, we have still this wave 5 intact. And I think we're probably entering the wave 3 of this wave 5. The market attempted a rally earlier this week because of the situation between Israel and Iran. But truth to be told, there's just far too much oil supply going around this year into a weakening global economy. What we have is that the OPEC countries are increasing their supply and ramping up the supply. And they might be following Trump's request, and they're doing loads of deals with US technology companies, etc. in return, and knowing full well the oil prices will be heading lower if they increase production. We also have US and Canada increasing their supply and exports. So there is an increase in supply going to 2025, but there's a weakening demand in terms of growth. So actually, the developed countries are demanding less oil on absolute terms than the year before. And countries like China and India have slowed down, especially China, as its economic strength is weakening and it has adopted EVs more quickly and widely than anticipated. So I do think the path of least resistance here is 5 waves down, and I think we're still early, but we could see the 50s handle in oil soon this year. So looking at Apple, so today's low open has managed to hold this wave 2 low just. So of course, I don't have a crystal ball to say whether it's going to break below this or not, but as long as this holds, and to be honest, as long as this larger degree wave 2 holds at 190 level-ish, we're still looking at a more bullish trend for this wave 3. But Apple has lagged its Magnificent 7 peers, is primarily relying not on business growth, but on share buybacks. So as an Apple investor, this is something you just have to be aware. You're not really looking at high growth from either the Apple Intelligence, iPhones, or iPads, but you are essentially waiting for the company to spend $100 billion, which it literally does each year, or every few quarters to prompt the price up. So not an extremely exciting stock, but I do think we could have room higher. Amazon, the current status is that it has fallen below the 200-day moving average, which is the orange line here, which is not unexpected. We did expect Amazon to pull back in wave 4 with the support around 195, which is the 0.382 pullback of this wave 3. So that is very typical of wave 4. And also, we had a very deep drawdown in this wave 2. So I do think that wave 4 probably wouldn't get much lower than 195. And after that, we could be looking at wave 5 back into 220 to 240 level-ish. Google is actually a stock that I want to get more bullish on, but the technicals haven't really helped me. So I'm going to lay out the bearish primary expectation in the bearish move versus a more bullish alternative. And admittedly, I have been switching around between those two expectations because the chart hasn't been that easy to digest. So I do think the risks are quite balanced, and take this with a pinch of salt. We have had a wave A, wave B, and wave C. And wave C, the intraday high did reach the 1.38 extension of this first wave. That typically does signal we could be looking at 5 waves up, with wave 4 being potentially at 163, which is a 0.78 extension of this wave 1. But it did close right on the 200-day EMA, and in between this 100 and 123% extension levels. So right now, I do think it's probably a 50-50 whether we topped in wave C and then turning down for a larger degree, or actually this is a larger degree impulsive wave 5 waves up, in which case we'd follow the red path. I would probably not do anything here. I wouldn't really try to chase or short the stock. I would just wait. The real test is once it gets to 163, what does it do? Does it bounce? Does it get to head back for this wave 5? Or is it actually going to go much lower? So that's the main question right now. And we are in a wait and see mode. Meta, I do think we are in a wave 4 retrace. I want to see it a bit deeper into 609 and possibly 592, which is a 50% extension of this wave 3, only because the wave 2 was quite shallow. So it's good to digest some of these rallies. And then before wave 5 up to complete this first phase of impulsive 5 waves up. Unfortunately, we launched our Meta Signals back here last week, and we are in a drawdown for the signals, probably a couple of percentage points. But I do think the larger degree trend is intact. And actually, if you look at the candles, every day it opens lower than the day before, but always end in green. So it's quite rare. We have 6 candles where it traded essentially flat or below the previous day, but it actually opened lower and moved higher on an intraday basis. So that suggests to me there is still a lot of buying interest every day after the open, as the bulls load up. Microsoft. So Microsoft has been extremely bullish in the past few weeks, not just after the earnings, but also before. And this is in line with what we expected going into April. So back in April, we expected 5 waves down to complete the wave C of a wider, essentially a flat structure in wave 4. And now we're seeing impulsive 5 waves up, essentially, and we're in the wave 3. So It does seem that wave 3 probably has topped here as a relatively long extension of wave 1, and we're due for pullback in wave 4. So this wave 4 could really land anywhere between 415 to 430. And that is quite standard wave 4 retrace just above the 200 EMA and this large volume profile here since the December top. I think we unlikely fill this gap here immediately. We could fill it later once we have all 5 waves completed. But in the near term, I really don't see us filling this gap just above the wave 1. If that is the case, we're probably looking at an ending diagonal structure of some sort, and the price action is less bullish than what we expect in that scenario. NVIDIA, I do think we're in a large degree wave 3, and I do think we will see all-time high this year. Currently, it's in a wave 4 of pullback of this large degree wave 3. That could end just around the 200-day moving average or above 123. So this has been quite a textbook 5-wave up rally from this April low. And I do think this whole sequence here from June 2024 to the April 2025 low is a expanded flat with wave A, wave B here above the beginning of wave A, and then wave C at the beyond the end of wave A. And ultimately, I have a target in the 160 region for the final top. Tesla started the rally quite strongly. It's been up 40% since the April low, which is pretty incredible. But it is a more volatile stock compared to its peers. So, and it did fall much more dramatically since December. What we have primarily, I do read this as a wave A, B, and C here, and wave C is unfinished right now. The reason I think this is A, B, C is because we appear to have 5 waves down from the December high. So this could be impulsive 5 waves down in wave A and 3 waves up in wave B. And then this wave C should really terminate beyond 370 level. So 370 to 400 is my target region for this wave C. Of course, if it gets above 420, then I'll have to reevaluate whether we've had a 5 waves up impulsive wave in motion, and therefore rethinking about this this structure here. So before we get to that level, this is my expectation. So I do expect Tesla to move higher in the near term to fill this out. SOXX, we've been expecting a wave 4 pullback, and that seems to start to complete right now. So we start covering last week when it was just around the 200-day moving average, and I said we should expect wave 4 pullback. And that could get down to 190 to 200 level. It's already entering this zone, so I'm not surprised if we get to 193 before attempting this larger resistance trend line again, and then moving to wave 5. So just wait and watch for now. And finally, this is a bonus, Palantir. This is a fun one. We've had a channel formation since December, and we are near the top of this channel, and which could be in non-Elliott waveland double top. We've tested this bottom region twice as well, and to me this does look like a wave 3 top here, followed by an expanded flat. So wave B is just marginally higher than the top of wave 3, and wave C could be lower than wave A, or running flat, wave C just slightly higher than wave A. But that's kind of not really that important right now because we're only at the beginning of this stage. So it's quite early to map out this entire wave C just yet. For the bulls, we could push higher into the 100% extension of this wave A, getting to the 140 level, but I do think that is the very, very top if this is a wave B. And of course, I could always be wrong. If we do get past 157 level above, then we're probably looking at 5 waves up. But my primary expectation is that we're filling out this wave C imminently. And we have been very bullish since mid-April. So basically since this pullback here, I did say very openly, we're going to get to the 120 level for the top of wave B. It's traveled just slightly further into 130. But now I do think the risk reward is just not there. If you buy it here, what are you really expecting it to achieve without further confirmation of this being a 5-wave impulsive move? So even if this, you can always wait for the wave 3 to fill out and then wait for pullback to buy the final 5th wave.